what Mr. Relly also said, that now many people look at the capital markets as time to make a fast buck. Lowest brokerage, more speculation than long-term investing. So how does the industry cope with this challenge where there's so much competitive pressure? How will you do the needful when it comes to financial literacy and understanding risk and reward if you're going to be bogged down by competitive pressures?
It's a good point, because I think those are the dynamics of how the brokerage industry in particular has changed over the last 5-7 years. So I think there was a point that was made about brick and mortar and a move towards electronification. So online trading platforms came just about 5-7 years ago. Initially, the online trading platforms were actually at a premium to the phone, the phone-assisted brokers who were handling the customers. And then there came a time with quite a significant paradigm shift where zero brokerages, flat brokerages started being offered. I think we need to understand, what the strategy is, for example, for a brokerage industry or for a brokerage industry player. So for someone who is focusing on providing only an execution discount brokerage platform, which is at a limited, monthly fee or a zero brokerage, clearly such a platform is a commoditized offering which only allows access to the market and therefore has no intention of understanding what the customer requires. Right? So we should clearly understand that a platform such as this, even if it is putting up 3 best trading ideas of today or the trade of the week, there is no analysis that has gone in to understand whether that particular advice is suitable to someone who's coming to trade on my platform just because he wants zero brokerage. Right, so we must take it upon ourselves to understand whether we are moving towards a situation of a simple execution platform or whether we are interested in actually increasing the understanding of the customer's requirements and then push product. Right, so now leave aside the zero brokerage or a no brokerage kind of a platform. Even the other online trading platforms, which is something which has come as a reactionary strategy after the 2008 financial market meltdown, because it is low cost, lower fixed cost. Very little has been done by our industry to really segregate the customer requirement, the point that Satya was making earlier. There seems to be a trend, and it's a regulatory push from SEBI to classify your customer, right? Under the investor advisory regulatory framework that has been put out, it is important for any intermediary first to understand who is coming to me, whether in person or electronically, right? You need to ask the relevant questions to understand his financial objectives, and in a very, shall I say, I will not call it ad hoc, but in a methodical way, try to bucket the customer, whether he's a low risk, moderate risk, high risk. I'm simplifying the whole thing, and then try to position a product. Now, a brokerage product is actually never addressing this particular classification of the customer at all. We must not fool ourselves. If we are really talking about positioning our products based on the risk assessment of the customer, we need to come up with products that are suitable. Now, here again, there is a different kind of a challenge. So I want to offer a product for my customer, right, which is, for example, wrapped around a PMS. Right? Because I have put together a product which will suit the low volatility kind of a requirement of my low risk customer. But then again, it breaks down because there is a regulatory entry barrier into this segment, because I cannot accept a customer unless he puts 25 lakh rupees with me. right? So there is this disconnect that we are all trying to find answers to. If I think that my value add after doing the classification is to recommend only a mutual fund, right? So what do I do? I look at my customer profile and I say that, okay, brokerage is not what I should offer him, because it could have a whipsaw kind of a large drawdowns. So this customer is a low risk customer. I should recommend only the mutual funds to him, right? So I come up with top 5 mutual funds with good history, good active managers, and I position that. The problem that I personally have is that we look at the performance of active managers under the mutual fund schemes also in an incomplete way. I mean, I ask most of the people in this particular room, and the way to select a mutual fund is to go to a particular website, credit rating agency, and look at the performance of 1, 3, 5, 1, 3, 6, 9, 12. And that's about it all. So you are just classifying the mutual fund on a unidimension, which is return. What has again got missed out is the risk, right? So if I am going to recommend a mutual fund scheme to my customer in a descending order of the return, right, which is a one year return or a 3-year return, I have ignored the risk element of it. Have I understood that the mutual fund, which is giving the highest return over a 1-year period or a 3-year period, also had drawn down months? So there is a way in which we all look at information which is not complete, right? So the way the information is put out is not telling the number of losing months, the maximum drawdown that happened, right? What is the alpha that this guy is generating as an active manager? So my problem, when we look at recommending solutions to our customers, is that we do a bit of a half-baked job. And I think it is important that we all recognize that standardized way of approaching customer offering is not what the customer is looking for. Even if he is going to come to you through the smartphone, if digitization is not going to allow us to customize products and offer the solutions according to what his financial objectives are, we are going to have another round of dissatisfied customers, and the downside of that will be that they are going to shy away, as you referred to in the first round. If we move this kind of an approach into the semi-urban and the rural guys, we are actually saying bye-bye to them for a longer period of time, because they're not going to come back for a longer period.
So, Vikas, is the broking industry doing enough to get to where Mr. Bhatnagar is saying? Identify your end customer, come up with products that suit them, and what will it take for the broking industry? Will it be higher fees? Do you think investors will be amenable to paying as much? Are they discerning enough? What is the brokerage industry doing now?
So I think, again, it's a part of evolution. If you ask me, whatever happened between 92 to 2003, for a lot of innovation, a lot of groundwork was put, and we saw industry grew, in last 10 years significantly. I mean, we used to charge 2% brokerage. Today we charge 5 basis point brokerage, and still industry is bigger than what it was. So I think industry will go through a significant amount of growth. There's no doubt on that, and I think it will go through a significant amount of change. As I said, that it has to move away from transaction-based model to advisory-based model, especially transaction-based model where the fees is going down consistently. In non-advisory-based model, that fees will continue to go down, because that is only execution-oriented, or that will get disintermediated. That will go directly. I mean, now today you can invest into mutual fund directly, without a broker. So I think, and only in advisory-based model you can do that. So I think it's a long journey. I don't think it is going to be a broking industry's job. It is an ecosystem, as Satya earlier mentioned, that everybody, I think SEBI is doing their job, exchanges are doing the job. Brokering community obviously has to be doing a lot in terms of preparing the customer. But I think a lot of it also, in my opinion, will get addressed through a new wave of technology, the new way of solutions which will come about. And I think the intermediaries who do not capture that wave or do not get ready for that wave, in my opinion, will automatically sort of be not part of the chain. So hence, I think everybody will have to kind of adjust to the chain and adjust to the need of the customer. But I think it is not going to be done in 1 year, 2 years, 3 years. It's a long process because our problems are long, as we said that, people don't know, people don't have financial literacy. So how do you explain a concept of risk reward to somebody who does not understand finances? So I think it's going to be a long drawn process. Also, I think we are seeing huge amount of evolution of products. So different kind of products are coming. We are seeing bond market which is not at all taken place, and it's beginning. I mean, you will see huge amount of business in that. You will see InvITs coming, you will see REITs coming. So I think we are seeing a sudden diversity of products coming through. So I think in middle of this, I mean, when we are right now struggling to only educate our clients about equities, suddenly we have a huge amount of options and products. So I think it is going to be a long drawn process, and I think everybody in the industry has to keep on striving towards educating. And more we talk about, more we, I think, it will keep changing, and that's the only way I would say.
Mr. Reddy, do you think the regulatory environment is conducive to a lot of options to offer to the investors? Vikas said that there'll be bond markets, offerings, there'll be rates, but again the perception is, wow, that company is raising bonds, but how do I, maybe I like it, I want the 8-10% return, and I don't want the risk and I want to go for it, but the awareness is not there. How to invest in it is not there. When it comes to REIT, again it's being seen, oh, this is the big boys club, and the retail investor is not going to get a bite out of that pie. What can be done? Will the bond markets deepen enough to bring on board the retail investor, and will that happen until the larger investors like the LICs, the pension funds, till they don't start taking a greater amount of risk? Well-rated companies can tap the bond markets easily, but what about those companies? Their ratings aren't that good. We just saw the recent case with Amtech and what happened with JSW, and now these large investors are risk averse. How will you get the retail investors into the fold when you're not seeing that participation coming in from the big boys?
So to that extent, I think debt is more complicated than even equities. So we've been, trying in the industry to get more and more retail participation for the debt on a debt side for very long, at least for last 2 decades, and hardly made any headway in that area. Though there are ways to, disseminate the information and include a larger customer base for the debt instruments, and if we use the exchange platforms to do the same and make the product more and more simple, I think there is an opportunity in that space. As far as regulatory framework, I think there is no dearth of regulatory framework, or it is very much conducive, and the framework and the construct is definitely available. There are no issues or constraint in terms of the framework, but the issue is in terms of coming out with the products which are very simpler, which are easy to understand at the retail customers level. So that's where we need to work. If you look at even product which is like forced by the government, sovereign gold bond, where apart from the opportunities of return on the gold as an asset class, they are giving the interest also 2.75%. So immediately disseminating the information about this product to the customer was also a challenge, and in first few tranches we find the participation was very low, and it has been picking up in last few tranches. So it's a process, and I'm sure if you keep the product very simple, and if you can make it easily available, accessible, and make them understand the risk attached with the product, then definitely there is a larger opportunities for us to work on this space.
Right. Mr. Bansal, is there an awareness amongst investors that we want to deploy money to create wealth, or to de-risk yourself? Are they willing to be attuned? You need a mindset change to look at financial market products. Is that happening? Are they looking at paying for the research and the advisory? Are they making an effort to understand the different products, or they ask you about this is my requirement, what can be offered? Are they aware, are they willing to pay as well for the differential services and the customization that they're being offered?
Yeah, I think here we have to go to our Indian psyche. I think here most of us have been brought up in an environment where advice is free. And we don't pay too much of attention whether advice is right. As long as it comes free, it's a good advice. Am I right? I think most of us have got up. When we were going for school and saying, sir, ye humko subject lena chahiye, shall I go for the subject? Yeah, it was coming free, so everyone is giving advice. Whether to go for this particular career, advice was free, so everybody giving advice. Whether right advice or not, says so is the case in the financial market. See, first and foremost, we must understand that unless you create a structural obligation for somebody to give advice and to hold him accountable, the only way you can hold him accountable is by getting into a contractual obligation. Isn't it right? How will you hold them accountable by contractual obligation unless you are willing to pay for it? Whether that payment is small or big is a different thing. So first and foremost, we have to educate the investor that there is a value in advice. And that value in advice does not come free. Somebody has to be paid for it. So you look at, now regulators have become fairly strict. You see when the markets go up, primary markets are boom. You see how many stock market WhatsApp messages keeps coming. You buy this stock tomorrow 30% up. High circuit, low circuit. I don't know how many advice keeps coming. Now obviously we have got far more restricted obligation around it. So we have not seen that coming. So that's the reason we have got that somewhere into our psyche, and that's something that we as a mindset have to change as a society. Yes, it's changing. It's changing. But still there is a challenge as to how that advice can be delivered in a customized manner. See, as we rightly identified, it's not the advice which is not available. Whether the advice is suitable to that particular investor has to be seen. So in case of a high net worth, ultra high net worth investor, you can still customize and deliver it one-to-one because cost of service can still be affordable. But when it comes to retail and mass affluent investors, that suitability part has to be brought in by bringing some amount of either packaging or some amount of, you can say, simplification of the product. I'll give an example. Let's look at it. India somehow has evolved between two different extremes. We have on one extreme physical asset class, real estate and bank fixed deposits, which most of our people are familiar with to an extent. I'm not talking about the people who have recently been brought into financial inclusion. On the other hand, we talk about financial derivatives. You talk about the intermittent asset class, which is how markets generally get evolved. They start from banking and they come to the plain vanilla debt, then come to high risk debt, then come to plain vanilla equity, and then they go to equity derivatives. Somehow